Hello, you beautiful humans. So our mortgage rates have doubled. A lot of people don't understand what's going on. Everybody look at the mortgage rates by their monthly installment, and that is the most wrong thing. The monthly installment is like a Chobu's Tinder profile. You never get the real picture. You want the real picture? Here it is. For this case study, we're gonna talk about you, the beautiful human. We are looking at a loan of $1 million and a 3% interest rate as compared to a 1.5% interest rate. Most people, what they do is they look at the monthly installment. They say, okay, 700 plus, not as bad as expected. And because of that, let's call it a day. However, right, the thing I want to look at, right, correct, is the average interest. As you can see, the monthly installment is only $764 higher. However, the interest is actually $1,232 higher. The difference between your interest and your monthly installment goes to your principal. You pay less principal, $467 less, sir. And guys, this math, this double, correct? Interest rate double. The interest that you have to pay also double. So do not let anybody tell you otherwise, okay? Let me explain to you what interest and principal is. Interest is the cost of borrowing. This is an expense. This is the money that goes to die. Principal is the money that you borrowed from the bank, okay? So if you borrow 800k, your principal is 800k. If it's a million, it's a million, okay? So this reduces every single month when you pay your mortgage because a portion of it goes to service the principal payment. One misconception about interest and principal is that it is fixed. The truth is that it is dynamic. Okay, so what happens every single month, interest is charged on the outstanding balance, and the principal that you pay will help to lower the ending balance. When your ending balance is lower, you can see your interest is actually much lower. And in the long run, your principal payment actually increases. And eventually, you will have paid enough principal to clear the entire loan, and therefore the property now belongs to you entirely. Before I get myself into any form of trouble, this is not investment advice. Everybody's case is unique, and because of that, everybody's advice should and will be different. With that said and done, what can we do? We can tahan. When we tahan, we just wait it out. Okay, we do not know how long this is gonna be. Alright, we can sell the property. This is if you think that the property prices are going down. However, the thing is, property prices usually track GDP. And MTI actually came out to say that recession is not gonna happen in 2023. But then again, which government will tell you when recession happening, right? Okay. The next thing is we can have better choices in terms of interest rates. Okay, fixed rates are already so expensive. Floating rates are looking to go up even further. But actually, there are floating rates that are not pegged to SIBOR or fixed deposit. They are pegged to some rates that are less sensitive to interest rates. You can talk to me to find out a bit more. The next thing is we can extend loan tenure. Naturally, when we extend the loan tenure, what happens is that your loan becomes cheaper because it takes longer to pay this down. And we can also consider paying down with CPF. CPF is giving us 2.5% interest. I made a video about it. You can take a look over there. However, when you are older than 55 years old, what you might want to do is do a withdrawal before paying down in cash. This actually helps you with the sequencing. Okay, you can also drop me a message. By dropping me a message, I'll be able to use my brain to fix your problem. So that being said, that's all the time for me. Have a great one. Stay awesome. Stay safe.